Today, we're going to discuss, should you build a simple three-fund portfolio, or simplify even further, by using an all-in-one fund of funds? We will compare these two investment methods, highlight their pros and cons as well as their similarities and differences, and help you decide which one might be right for you. This is a question that has been gaining a lot of traction, especially among those new to investing, or looking to simplify their investment approach. Stay till the end for 3 key takeaway messages. If you find topics like this helpful, take a moment to subscribe for future content. Your support is very much appreciated. First off, let's talk about the three-fund portfolio approach, pioneered by John Bogle, the founder of Vanguard, and his team of Bogleheads. The beauty of a three-fund portfolio lies in its simplicity, diversification, and cost-effectiveness. Essentially, it consists of just 2 or 3 equity and bond index funds. This method ensures broad diversification across regions, sectors, and asset classes, which is crucial for minimizing risk. It also prevents any inherent bias from skewing your portfolio. Let's look at a simple 60-40 portfolio, with 60% equities and 40% bonds. For the equity portion, a fund like the Vanguard FTSE Global All-Cap Index Fund will give you broad exposure to global stocks. For bonds, the Vanguard Global Bond Index Fund is a good base, with maybe the Vanguard Global Short-Term Bond Index Fund for extra stability. This setup provides a balanced mix of global equities and bonds, suitable for a variety of investors. Now, the popular 60-40 split isn't a one-size-fits-all approach. For younger investors, especially those in their 20s or 30s, a more aggressive allocation, such as a 90-10 portfolio or even 100% equities, might be more appropriate. The reason being, younger investors have a longer time horizon, and can afford to take on more risk for potentially higher returns. I'd personally lean towards 90-10 or even 80-20 for one key reason: opportunistic rebalancing in bear markets. Having 10 to 20% in reserves, so to speak, in the form of more stable bonds, enables you to opportunistically buy more equities, at heavily discounted prices, in bear markets when the market drops 20% or more. However, unlike standard rebalancing practices, if you're looking to maximize absolute returns, I would further recommend not rebalancing from equities back to bonds in a rising market, but only if you're not approaching retirement or already retired. This maximizes the opportunities for your portfolio to grow, with a long accumulation runway ahead of you. Here are some reasons in favor of the three-fund approach. First, simplicity. It's easy to understand and manage. You don't need to worry about picking individual stocks or bonds. However, there is some management overhead, since you are responsible for managing and rebalancing the portfolio. Second, diversification. By investing in these 3 funds, you spread your investments across various sectors and regions, reducing the risk associated with any single market or sector. However, it's easy to supplement the portfolio with satellite funds if you want more exposure to specific asset classes, regions, sectors, such as small caps, emerging markets, or technology. Third, low cost. Index funds typically have lower expense ratios, compared to actively managed funds, which means more of your money stays invested. This cost efficiency is a key advantage of index funds. Additionally, it's important to note that active fund managers underperform their index benchmarks, in a staggering 80 to 90% of cases, as the SPIVA reports have consistently shown. Fund of funds are appealing due to their low cost and light touch management. The fund manager will define the portfolio allocation, the light touch part, but the underlying investments are often based on index funds. These funds often come with names that indicate their risk level, such as cautious, balanced, and adventurous. Some popular examples include Vanguard LifeStrategy, Legal and General Multi-Index, and HSBC Global Strategy. One main caveat here is home country bias, which is evident in the Vanguard and Legal and General funds. These allocate a larger portion of the portfolios to the UK than its relative market size. I'm not convinced by the arguments for home country bias, which artificially inflates the allocation for a home country, without any basis in a reputable index benchmark. This is another example of the management style for these fund of funds, and represents a slightly heavier-handed layer of active management. For this reason, of the 3, I have a slight preference for the HSBC Global Strategy funds. This is also reflected when looking at the performance, relative to the HSBC FTSE All World Index Fund, as a proxy for the FTSE All World Index. The strong correlation gives me a higher level of confidence that the HSBC fund managers adopt an active management style that is aligned with and reflects some of the key index benchmarks. In addition to the benefits of the three-fund portfolio we discussed, fund of funds offer further advantages. First, automatic rebalancing. One of the biggest advantages is that these funds automatically rebalance their portfolios, in some cases daily, to maintain the desired asset allocation and stay aligned with your investment goals. Studies have shown disciplined rebalancing reduces risk and volatility and improves risk-adjusted returns over the long run. Second, convenience. Fund of funds provide a hands-off approach with an all-in-one solution. For example, suppose you're in your 20s and you want an 80-20 portfolio. Here, the HSBC Global Strategy Adventurous Fund is a good match, which maintains a minimum of 80% equities. That's it, job done. You don't need to worry about managing multiple funds or rebalancing your portfolio. You will pay marginally higher fees for this service, anywhere from 0.05% to 0.2% more in fees, but I think this is acceptable, with Vanguard and HSBC having some of the lowest fees. Third, risk spectrum. Fund of funds offer a range of portfolios to suit a range of risk tolerance levels. All you need to do is determine your risk profile and select the matching fund. This also makes it easier to transition to a portfolio that better reflects your updated risk profile and desired asset allocation later in life. Just switch between two fund of funds. The sheer simplicity of transitioning from one portfolio option to another makes it easier to adjust your portfolio's risk exposure as you age or when your circumstances change. We've looked at some of the benefits and similarities of the three-fund portfolio and fund of funds. What about key differences? First, rebalancing. With a three-fund portfolio, you need to manually rebalance your investments, whereas a fund of funds automatically handles this for you. That said, an increasing number of robo-advisors and investment platforms now offer rebalancing support. I covered manual rebalancing in another video, and this is actually quite straightforward with a simple three-fund portfolio. Second, control. A three-fund portfolio gives you more control over your asset allocation and fund selection. With a fund of funds, you're relying on the fund manager's decisions regarding asset allocation and fund selection. Third, accumulation versus decumulation phase. For me, this is the most crucial difference. A three-fund portfolio provides direct access to individual asset classes, which becomes more important in retirement. Why is this significant? With a fund of funds, its value is determined by the valuation of its constituent funds, limiting your ability to liquidate specific asset classes. During a market downturn, you might want to preserve your growth potential in equities. With a three-fund portfolio, you can choose to only sell less volatile assets, like short-term bonds, to meet your income needs. This level of control and flexibility becomes invaluable during retirement, as it allows you to avoid selling long-term growth assets in a market crash. There are three caveats with the fund of funds approach. First, target date funds. These are a type of fund of funds that automatically adjust the asset allocation as you approach a target retirement date. While convenient, they offer less control over how the portfolio changes over time, often resulting in the portfolio becoming too conservative, too early. Second, home country bias. Some funds like Vanguard LifeStrategy may have a bias towards domestic investments. It's important to ensure your portfolio is broadly diversified and generally aligned with key index benchmarks. Third, regular portfolio review. Regardless of whether you choose a three-fund portfolio or a fund of funds, it's crucial to review and update your portfolio allocation to ensure it aligns with your investment goals, especially as you near retirement. This typically involves reallocating towards more bonds to reduce risk and volatility. However, it's easy to overlook this when you invest in a fund of funds, because it is so simple, convenient, and hands-off. That's just human nature, since the whole point of a fund of funds is to set it and forget it. But you can't afford to do this as you approach retirement. Okay, as we wrap up, let's take a step back to look at the big picture, with three parting thoughts. First, if you're a young investor in your 20s or 30s, get comfortable with equities. In fact, a lot of equities. It's generally advisable to have an overweight allocation in this asset class, at least 80% or higher, depending on your risk tolerance. This is important, as equities have consistently outperformed bonds over the long term, which is further boosted thanks to compounding. Additionally, you can afford to overlook market volatility, since you're not relying on your portfolio for income. Maintaining some bonds is particularly beneficial for opportunistic rebalancing during bear markets. Second, if you're new to investing and concerned about making the wrong decisions or unsure where to start, I suggest starting simple. Pick a fund of funds that aligns with your risk tolerance and start investing. Importantly, automate monthly contributions from your paycheck based on your circumstances. The more time you spend in the market, the greater your returns, due to the power of compounding. Remember that the longer you wait, the more you miss out on the opportunity for exponential growth. Consider these outcomes from Monte Carlo simulations in Portfolio Visualizer. One scenario involves a fixed monthly contribution of $100, while the other involves $250, both invested in a 60-40 portfolio over 30 years. If you're in your 20s now, there's a 50% probability you could have $165,000 and $415,000 respectively, by the time you're in your 50s. This means that your monthly contributions of $250 could grow to $415,000. That's the power of compounding for you. Third, as you near retirement, it's crucial to review your portfolio allocation. With more experience under your belt, consider transitioning to a 3-fund portfolio around 5 to 10 years before retirement. This approach offers more control than the fund of funds approach. However, a word of caution: avoid an excessively conservative retirement portfolio that is heavily weighted in bonds. Remember, you have a long runway ahead of you in retirement, especially with increasing life expectancy. While it is prudent to dial down the equity allocation, for example to a 60-40 portfolio, it's important to maintain a healthy allocation of equities in retirement to mitigate portfolio longevity risk. There are steps you can take to mitigate sequence of returns risk, such as using the simplified bucket strategy, which I discuss in another video. This straightforward 6-year, 2-bucket strategy is designed to offer peace of mind, without the unnecessary complexity of the 3-bucket strategy. If you are still here, thank you for your time, and I hope you found this helpful. Don't forget to like, share, and subscribe for more content. Thanks again for watching, and I'll see you in the next one.